chair now recognizes himself for 5 minutes for questioning. I just failed to, at the outset, understand the logic of this idea that in order to protect the economy and financial stability, we have to destroy the economy. That doesn't make sense to me. I note with interest that many of my colleagues on the other side of the aisle and stakeholders from across the ideological spectrum have expressed significant concerns with many aspects of the Basel III endgame. There's a reason why there's bipartisan concern. Because on a bipartisan basis, we don't believe, Congress does not believe, that the way to protect the economy is to destroy the economy. Many comments on the proposal relate to treatment of mortgages or green energy tax credits. Both issues are examples of unintended consequences from a proposal that contains shockingly deficient analysis. Yet, concerns and comments have been expressed from a wide variety of stakeholders covering far more issues than just mortgages and tax credits, including issues concerning market risk, abandonment of internal models, and more. The bottom line for commenters is concern about the unknown and unestimated negative effects on credit availability and costs from the proposal from homebuyers, consumers, manufacturers, disadvantaged communities, municipalities, and businesses, large and small. Mr. Barr, can you touch on the treatment of market risk in the Basel III proposal and talk about likely impacts?
Thank you, Congressman. Mr. Chairman. Market risk is a very complicated subject. It's very difficult to measure, but it can and is measured in the proposal. The problem is it's covered twice. After the financial crisis, there was a realization that value at risk models, which cover problems that happen most of the time, but not all of the time, was not a sufficient measure, and you needed to actually look into the tail of risk and cover the worst case. The U.S. did that, the Federal Reserve, through the global market shock, and basically had stresses worse than the global financial crisis. The rest of the world did not adopt a stress test like the Fed. Instead, it went off and worked on a market risk add-on or supplement to Basel, which it called, oddly, the Fundamental Review of the Trading Book. That did effectively the same thing as the global market shock. And now everywhere else in the world, they are going to adopt the Fundamental Review of the Trading Book as the measure for market risk, for market risk. And only in the U.S. are we apparently on a path to adopting both and doing a pure double count. I should say there are some other issues within the Fundamental Review of the Trading Book. There are some assumptions that don't make a whole lot of sense. There's an expected shortfall method that really disqualifies the use of models in a lot of cases where they ought to be used. There's something called, things that can't be modeled, and you then get a punitive stress test or standardized charge. So there are problems within the Basel proposal, but the largest problem is the overlap.
Yeah, this double counting, I think, is really at the core of why this proposal would make our economic system less competitive internationally. Mr. Barr, can you quickly also discuss the proposed abandonment of internal models and whether in doing so, financial institutions' risk profiles and portfolios will be homogenized and thereby actually threaten financial stability?
Sure, it's an excellent point. In the U.S. for the largest banks, we are currently using what's called the advanced approach, is well named, whereby granular bank models are used as opposed to just lumping together classes of loans that don't have a lot in common, which is what standardized approaches do. That system's been operating since 2011 under extraordinarily stringent guidance from the agencies, and they have at no point between then and now raised any concerns about the accuracy. There's never been an action against a bank. More importantly, when Basel, when it adopted its standardized approach, it assumed that standardized approach would effectively apply at 72.5% of where it landed, because banks would be able to use internal models. Only in the U.S. are they proposing to eliminate the use of models and effectively set the standardized charge at 100%. That will certainly herd banks, as you know, into asset classes that are favored by the standardized approach.
Mr. Gwynn, real quick, Vice Chair Barr has argued that the effects of this onerous proposal are modest, amounting to increased average loan costs of just a few basis points. Can you discuss whether you believe that there will be a more substantial impact of this proposal?
So I do think that other economists have looked at this and suggested that there's going to be a much bigger impact. Certainly, the biggest impact is operational risk, but operational risk will affect the cost of loans as well. And the market risk, although it's not directed at lending, it is directed at raising debt and equity capital in the capital markets, and it will increase the cost there.
Mr. Gwynn, how important is it for the Fed to provide the public and regulated institutions with sufficient time to comment on the rule's quantitative impact study?
So I think that's incredibly important. I think one of the surprises here is that they didn't do the quantitative impact study at the same time they released the rule, but I think people need 60 to 90 days, I think, to actually absorb it and comment on it appropriately.
My time has expired, but again, I mean, it is possible to prevent disease by killing the patient, but I don't think we should kill the patient.